Good day, everyone. Welcome to our presentation on one of the most fascinating tools in technical analysis, candlesticks. Candlestick charts aren't just colorful visuals. They're vital for understanding market trends, predicting reversals, and making informed trading decisions. In this video, we'll guide you through the basic structure of a candlestick, key individual patterns and what they indicate, blended patterns for deeper insights, and how to apply these concepts with local examples from the Philippine Stock Exchange.
Candlestick charts trace their origins back to 18th century Japan during the Edo era. They were developed by Munehisa Homma, a wealthy rice trader often referred to as the god of markets. Homma revolutionized market analysis by creating this unique method of visualizing price movements to track and predict the price of rice, which was a cornerstone of Japan's economy at the time. Homma spent years studying ancient records and deciphering the symbols and numbers associated with rice trading. Using this knowledge, he developed the first candlestick charts. These charts not only tracked price fluctuations, but also captured the emotions and psychology of traders, a concept still relevant today. Fast forward to today, candlestick charts have evolved into a crucial tool for traders and investors worldwide, helping them analyze price trends and make informed decisions across various financial markets.
Let's break down the structure of a candlestick and understand what each part represents. A candlestick is a single bar in a chart representing price movement for a specific time frame, like a day or an hour. Each candlestick provides four critical pieces of information: the opening price where trading started, the closing price where it ended, the highest price, and the lowest price during that period. The main rectangle in the candlestick, called the body or real body, represents the range between the opening and closing prices. Extending from the body are lines called wicks, shadows, or tails, which show the highest and lowest price points during that period.
Color plays a big role. The color of the body indicates whether the price went up or down during that time. If the close is higher than the open, the candlestick is bullish, typically green or white. It means the price appreciated and moved upwards. If the close is lower than the open, it's bearish, commonly red or black. It shows the price depreciated and moved downwards. For a green candlestick, the bottom of the body represents the opening price, while the top shows the closing price. For a red candlestick, the top of the body represents the opening price, while the bottom shows the closing price. The highest end of the upper wick marks the highest price, and the lowest end of the lower wick indicates the lowest price.
What can the size of candlestick reveal? A larger body reflects stronger momentum, showing a significant difference between the opening and closing prices. This means that prices are consistently rising or falling from open to close, often signaling the start of an uptrend, continuation of a bullish momentum, or a downtrend, continuation of a bearish momentum. A smaller candlestick body typically means lower market activity or indecision. When the real body is small, it indicates that the opening and closing prices were close to each other, showing little price movement during the time period. This suggests that neither buyers nor sellers had strong control, resulting in a balance of buying and selling pressure.
Why is understanding candlesticks important? Candlesticks give us a clear and visual representation of market sentiment and price movement. By looking at these patterns, traders can easily determine whether buyers or sellers are in control. This helps identify trends as well as potential market reversals, giving traders a crucial edge in making decisions. Now that we know the basics, let's dive into individual patterns.
Let's start with the Marubozu candlestick, which is characterized by a single candle with a long body and no or minimal shadows or wicks. When you see a Marubozu candlestick, the fact that there are no shadows tells you that the session opened at the highest price and closed at the lowest price of the day. It signals strong market momentum and confidence in the direction of the price movement. The Marubozu candlestick can be bullish or bearish depending on who controls the day. A Marubozu in an uptrend indicates that bulls are aggressive, buying the asset, and may continue upward. A bearish Marubozu in a downtrend at the top of an uptrend indicates more selling pressure. When a bullish Marubozu appears at the right location, this may show the end of a downtrend and start of an uptrend, or the end of a pullback resuming an uptrend. When a bearish Maribozu appears at the right location, it may show the end of an uptrend and start of a downtrend, or the end of a pullback resuming a downtrend. Consider buying when a bullish Maribozu appears on the uptrend and selling when a bearish Maribozu appears on the downtrend. However, the Maribozu candle on its own is not considered as a strong trading signal.
Doji in Japanese means the same thing, wherein the open and close price is exactly the same, resulting in a small body with long upper and lower shadows. Doji candlesticks can look like a cross or a plus sign. A doji signals indecision in the market, where buyers and sellers are in balance. Some analysts interpret this as a sign of impending price reversal. However, it may also be a time when buyers or sellers are gaining momentum for continuing a trend. But the real confirmation of trend change comes with the next candlestick or sequence of candlesticks. Consider selling when doji is found in the uptrend and buying when in the downtrend.
A hammer is a price pattern in candlestick charting that occurs when a security trades significantly lower than its opening but rallies within the period to close near the opening price. The candlestick has a small body near the top and a long lower wick resembling a hammer. This indicates that sellers initially had control but were overpowered by buyers, suggesting the market may be shifting upward. Usually, the color of a hammer candlestick does not matter, but sometimes a green hammer gives a stronger indication and more positive results than a red hammer. When a hammer candlestick pattern appears at the right location, it may show the end of a downtrend and start of an uptrend, or the end of a pullback resuming an uptrend. Before initiating a trade, investors should keep certain points in mind. First, it should be created at the end of a downtrend, and there should be at least 2 to 3 bearish candles before the formation of a hammer. The lower shadow should be 2 to 3 times longer than the body of the candle. A big green candle or bullish candle should be formed after the hammer to confirm the reversal, and the confirmation ensures the reversal is valid. Consider buying when a bullish follow-up candle is confirmed. An inverted hammer is a candlestick pattern that looks exactly like a hammer, except it is upside down. The inverted hammer has a long upper wick, a small real body, and little to no lower shadow. The major difference between the hammer and inverted hammer is the position of the shadow or the wick. Despite being inverted, it's still a bullish reversal pattern, indicating the end of a downtrend and the beginning of a possible new bullish move.
Next is the hanging man. The overall shape of the hanging man looks quite similar to a hammer candlestick, which is characterized by a short or no wick on top of a small body with a long shadow underneath. The main difference is that a hammer candlestick leads to an uptrend, whereas the hanging man leads to a downtrend. The hanging man candlestick can either be green or red, but its structure and position is far more important than its color. A hanging man shows that sellers initially drove the price down significantly after the market opened, but buyers managed to push it back up near the opening price. This pattern appears during an uptrend and signals a potential reversal, warning that prices could start falling. If a hanging man forms at the end of an uptrend, it's important to wait for confirmation. For instance, a bearish candlestick following the pattern can indicate that selling pressure is starting to dominate.
And finally, we have a shooting star. The inverted hammer and shooting star are similar candlestick patterns with opposite meanings based on their position in a trend. The inverted hammer, a bullish reversal pattern, appears at the end of a downtrend, signaling potential upward momentum. The shooting star, a bearish reversal pattern, forms at the peak of an uptrend, warning of a possible price decline. Both patterns feature a small body near the lower end, a long upper shadow, and little to no lower shadow. While the inverted hammer points to buyers gaining strength, the shooting star indicates bearish sentiment. Traders typically wait for confirmation from the next 2 or 3 candlesticks before acting, ensuring the trend reversal is valid. They consider options such as selling or shorting if the pattern following a shooting star also indicates continued bearish momentum. Individual patterns are useful, but combining them gives us even stronger signals. Let's move on to blended patterns, which involve multiple candlesticks working together to tell a story. Let's analyze a few key ones.
An engulfing candlestick is a chart pattern where a large candle completely covers or swallows up the body of the previous smaller candle, indicating a shift in market sentiment. It can be bullish or bearish depending on the direction of the trend it reverses. A bullish engulfing candle forms when a small bearish candle is followed by a large bullish candle. The bullish candle's body completely engulfs the bearish candle's body, indicating a potential reversal of the previous bearish trend. A bearish engulfing candle forms when a small bullish candle is followed by a large bearish candle. The bearish candle's body completely engulfs the bullish candle's body, indicating a potential reversal of the previous bullish trend. The size of the engulfing candle's body is an important factor to consider when analyzing the pattern. A larger engulfing candle indicates a stronger shift in market sentiment and a higher probability of a trend reversal. Conversely, a smaller engulfing candle may indicate weaker sentiment and a higher chance of a false reversal signal. Therefore, traders should pay attention to the size of the engulfing candle's body when using this pattern in their analysis. Traders can use engulfing candles as entry and exit points in their trading strategies. When a bullish engulfing candle forms after a downtrend, it can indicate a potential reversal to an uptrend. Traders can enter a long position at the opening of the next candle after the bullish engulfing candle. On the other hand, when a bearish engulfing candle forms after an uptrend, it can indicate a potential reversal to a downtrend. Traders can enter a short position at the opening of the next candle after the bearish engulfing candle.
Up next is the Harami pattern, which consists of two candlesticks, with the first candlestick being a large candlestick and the second being a small candlestick whose body is contained within the first candle's body. Harami means conception or pregnant in Japanese. The first candlestick is seen as the mother with a large real body that completely encloses or embodies the smaller candlestick, creating the appearance of a pregnant mother. A Harami candlestick pattern is considered another trend reversal pattern, which can either be bullish or bearish, depending on the direction of the price action. A bullish Harami occurs at the bottom of a downtrend when there is a large bearish red candle on day 1, followed by a smaller bearish or bullish candle on day 2. The most important aspect of the bullish Harami is that prices gapped up on day 2 and the prices was held up and unable to move lower back to the bearish close of day 1. A bearish Harami occurs at the top of an uptrend when there is a large bullish green candle on day 1, followed by a smaller bearish or bullish candle on day 2. Again, the most important aspect of the bearish Harami is that prices gapped down on day 2 and were unable to move higher back to the close of day 1. This is a sign that uncertainty could be entering the market. In both cases, this weakness indicates that a trend reversal may be imminent.
The dark cloud cover pattern involves a large red candle forming a dark cloud over the preceding candle. It is a two-candle pattern. The first candle is bullish, and the second bearish candle starts by gapping up but then recedes below the midpoint of the first candle. Dark cloud cover is a bearish reversal candlestick that's formed after an uptrend. It signals a potential weakness and that the market might be headed for lower prices. It's important to understand that if the second candle completely engulfs the entirety of the preceding bullish candle, it's not the dark cloud cover pattern, but rather a bearish engulfing pattern. Dark cloud cover signals a gradual shift in momentum, requiring the bearish candle to pierce at least halfway into the previous bullish candle, while engulfing pattern shows a more decisive shift, with the bearish candle overtaking the bullish candle entirely. Both patterns indicate potential reversals, but the engulfing pattern is typically considered stronger and more reliable. As always, the dark cloud cover candlestick pattern should not be used in isolation. It must be combined with other triggers and technical analysis tools. Most traders consider the dark cloud cover pattern useful only if it occurs following an uptrend or an overall rise in price.
A piercing pattern is a 2-day candlestick formation, signaling a potential reversal from a downtrend to an uptrend. On the first day, strong selling drives the price to close near the low, while the second day opens lower but closes near the high, covering at least half of the previous day's bearish candle. This suggests weakening selling pressure and growing buyer interest, often indicating a short-term upward move. While the bullish engulfing pattern is stronger, fully overtaking the bearish candle, the piercing pattern only requires the bullish candle to close above the midpoint of the previous bearish candle. The piercing pattern and dark cloud cover visually mirror each other but signal opposite trends. In a piercing pattern, the second green candle's close above the midpoint shows buyers overtaking sellers and hints at a bullish reversal. To confirm the piercing pattern signal, traders often rely on additional technical indicators. Since bulls don't entirely reverse the first day's losses, further bullish movement may be needed before a clear buy signal is established. Now that we've covered some key candlestick patterns and how to trade them, let's bring it closer to home with some local market examples. By applying these patterns to stocks listed on the Philippine Stock Exchange, we can see how these strategies play out in real-world scenarios. This will give us a practical understanding of how candlestick analysis can guide trading decisions in our local context. From September 24 to 25, we observed doji patterns in Petron Corporation's stock chart. A doji forms when the opening and closing prices are nearly equal, indicating market indecision. This pattern often signals a potential reversal or the start of an upward trend, depending on the context. The confirmation came on September 26 when a bullish Maribozu appeared. A Maribozu has little to no wicks and shows a strong bullish sentiment, with the price opening at its low and closing at its high, indicating strong buying pressure and a likely continuation of the upward trend. On October 10, a bearish shooting star appeared. This pattern features a small body at the lower end of the candle with a long upper wick, indicating that buyers initially pushed prices higher, but sellers regained control, driving the price back down. The next day, on October 11, a bearish Maribozu confirmed this shift in sentiment. With no wicks and a close at its low, the bearish Maribozu signals strong selling pressure and a continuation of the downtrend. Looking at Petron's performance over the last 3 months, the candlestick patterns have accurately reflected the broader market trends. The doji patterns and bullish Maribozu on September 26 were followed by an upward trend, confirming the reversal signal. Similarly, the shooting star on October 10 and the bearish Maribozu on October 11 preceded a sustained downward trend.
In the case of Century Pacific Food, we observe a bearish Harami pattern from May 31 to June 1. This pattern is characterized by a large bullish candle on the first day, followed by a smaller bearish candle on the second day, which remains entirely within the body of the first. This indicates a potential end to the current uptrend or the conclusion of a pullback, signaling a possible resumption of a downtrend. Later, from August 6 to 7, Century Pacific Food forms a bullish engulfing pattern. This pattern features a bearish candle on the first day, followed by a larger bullish candle on the second day, that completely engulfs the body of the bearish candle. This pattern suggests a potential end to the downtrend or the conclusion of a pullback, signaling the start of a new uptrend. The bullish engulfing pattern aligns with upward trend seen after August 7, confirming market expectations for a potential price recovery. Over the last 6 months, these patterns have confirmed key trend reversals for Century Pacific Food. The bearish Harami pattern identified on June 1 coincided with the broader downward trend, while the bullish engulfing pattern on August 7 marked the beginning of a notable upward movement. These candlestick patterns not only highlight potential turning points, but also reinforce the expected market trends, demonstrating their usefulness in confirming broader market dynamics. In conclusion, while memorizing candlestick patterns can be a valuable skill, identifying them in real-time market conditions isn't always straightforward. Please note that you shouldn't trade purely based on candlestick patterns. Think of them as hints or clues about where the market might be headed, not as absolute decision makers. To make more informed trading decisions, you should combine candlestick patterns with other tools like technical indicators, different trading strategies, and broader market analysis. For example, just because you spot a bullish engulfing pattern doesn't guarantee that the price will rise. However, it can be a strong signal that the price may move in that direction. By blending candlestick analysis with other methods, you'll gain a more well-rounded and reliable approach to trading. Thank you for listening to our report.